can the market action in the next 30 days or so predict who the winner of the election might be? If the incumbent party is going to stay in, the belief is that the market would be positive. If it's going to be a change of power, the belief is that the market would be negative. So it's one of those difficult times where I don't know what comes first. Is the market going to tell us, or are we going to tell the market what to do when things happen? I would be vigilant in October and watch for some of those big shifts. And then, as we know, some of the most sensitive sectors, you've got things like aerospace and defense that usually gets hit, or at least sees volatility based on policies and how polling is going. Healthcare can be up there, although I do like healthcare right now in this environment. So just being careful. As always, I would never position a portfolio ahead of an election based on what you think the outcome is going to be.
Welcome to the On the Tape podcast, the Monday edition, the final Monday in September. I'm Guy Adami, always joined by Dan Nathan and the brilliant Elizabeth Young-Thomas. She, of course, of SoFi. Elizabeth, how are you?
I am good. Would have been better if the Packers won yesterday, but they came close. They were down 28-0 at some point.
It was a spirited comeback in the league where they play for pay, yet they fell short. In the NFL, you get no style points. Dan Nathan, how are you?
I'm doing great. The Georgia Bulldogs were also down 28-0 Saturday night to the Alabama Crimson Tide, and they came all the way back. That was a great finish there. You got to talk, you got to give me your 2 cents on that, guy.
They came storming back, and I'm going to talk about that. By the way, stick around because along with Dan Nathan, Danny Moses and I had a conversation with Vincent Daniel that will be on sort of the flip side of this podcast. So stick around for that. And yes, let's address that Alabama game. They got out to a huge start against the Georgia Bulldogs, who didn't seem prepared to play in the first half of the game, only to, as Dan said, storm back in the second half, take the lead. The ensuing kickoff went to the Crimson Tide, and then they proceeded to throw a 75-yard touchdown pass, which sort of iced the game, although Georgia did come back only to throw a pick in the end zone. Elizabeth, how did I do there, Dan?
You did great. By the way, Vincent Daniel of Seawolf Capital, you know him from the Danny Porter and Steve Eisman days. He's got some good stuff he came with, so that's pretty cool. Guy, everybody wants to talk about China, and everybody wanted to avoid China like it was the plague. This was just a couple weeks ago. So it went from 52-week lows to new 52-week highs, and it's raging. Liz, when you see something like that in a market that you don't cover particularly closely or you don't follow particularly closely, what do you think about that? Because, again, the S&P rallied back, new highs, NASDAQ hasn't gotten there. The Russell 2000 can't kind of get out of its own way. What is China and their stimulus, both monetary and fiscal, and the rally subsequently in equities, what do you think that means for the S&P 500 in general?
Well, it's caused some differences in sector performance in the S&P. We saw materials come alive again on the hope that there would be demand in China that would drive materials demand, perhaps even drive some commodity prices higher, although the oil prices have not seen that yet. But the thing about what's going on in China right now, first of all, absolutely the stimulus is a positive thing. They needed to do that. In fact, they probably needed to do it much sooner than they did. In any event, the fact that it's happening is a good sign. I believe we talked about last week, it's probably not quite enough yet. I would perhaps expect more announcements of stimulus, particularly ones that are focused on the property sector, because that's been the biggest issue over there. And then the objective, what's been published as the objective, is to get to their growth target of 5% GDP growth in 2024. They're behind target right now, so they needed to come out and be aggressive to try to get to that target. But the true objective is going to be to get the country out of a deflationary process. And that's probably going to take a little bit longer than a few days in the stock market. So what we're seeing right now, I would look at this the same way that I would look at any big move in markets, both on the upside and the downside. Markets tend to overshoot in the near term. Today's move, because of the size of it, I don't know what it was up just a few minutes ago, but at some point this morning, up 9%. Because of the size of it, we may end up giving some of that back. It feels a little bit like a FOMO move in the moment.
What I find fascinating about this, and we talked about this on Fast Money, we talked about it on Market Call. They're seemingly throwing all their chips in the middle of the table, and they say, that's it, we're all in. And one has to question what type of hand they're going all in with. And it's working clearly for their markets. And quite frankly, as much as I've gotten wrong over the years, and it's been a lot, this is one that we've collectively gotten right. If you go back and look at the FXI, it traded down to 21 in October of last year. It basically traded down to 21 again early this year. And we actually said, here's your opportunity to trade this from the long side against those prior lows. Now, I thought it would take a lot sooner to make the move. It's obviously taken a lot longer than I thought, but here you go. And in the FXI, at least, you've seen about a 50% move. And you're starting to see that in some of the underlying names. Alibaba is the first one that comes to my mind, Dan. And we've talked about this name forever as well, saying how it's been a broken company without question. But along the 4 or 5 years since it made its all-time high, you've seen at least 7 or 8 35 to 50% bounces off lows. And we're in the midst of that now. So it's really interesting to watch. I don't know necessarily what it means to our markets, if anything. What I do think, though, it's going to reaccelerate some of these resource trades and potentially reaccelerate some of the commodities trades that have been underwater.
Yeah, no doubt. I mean, I think that's a great point, and Liz just made that obviously too, about the things that are working here in the U.S. on the back of this, and that's something to keep a close eye on. It's interesting when you look at the Shanghai Composite, which from a closing low, which I just mentioned, just a week or two ago, to a closing high yesterday, up about 26%, kind of commensurate with what the FXI has done. But to your point, Guy, off of the 52-week lows, the FXI is up nearly 60%. It's really important, and we talk about construction of ETFs all the time. When you look at the FXI, the top holding, to your point, Guy, is Alibaba, about 9.5%. Meituan, which is also a consumer-focused e-commerce company, about 9.5%. Tencent, 8.5%. China Construction Bank in there, so is one bank in the top 5. That's about almost 6%. And then JD.com. So the construction of the FXI is very geared, for the most part, at least 30% or so, towards consumer exposure. And when you think about this, we think about some of the prints that we've had in GDP. What was that? GDI, Liz, was about 3% or so. The Chinese are trying to get GDP back up to 5%. You know what I mean? So we have never had that small of a difference between our GDP and theirs. You know what I mean? So the idea that we are basically 2% or a little less than that away is pretty staggering. Do you think China can be the engine of growth, especially when you think about the tariffs that we have, the trade war that's going on, the focus on chips and advanced chips in general? And Guy brings this all the time up, geopolitical risk as it relates to manufacturing of chips, because a lot of folks who know a lot more about geopolitics and how it affects economies and markets over the last couple of years. And Guy, we had one on Fast Money the other day. If you have some sort of incident with Taiwan and chip production gets halted in Taiwan Semi and some of the other ones, it's going to make inflationary pressures that we saw in energy with the Russian invasion in Ukraine look like, a blip.
Okay, well, let's start with this. So, and I did talk about this a little bit last week too. So your question about, can it be the engine that reignites global growth? First of all, what China is doing is trying to ignite the part of its economy that makes up the largest proportion of GDP. It's called gross capital formation. So they're trying to stimulate the corporate sector, and they're doing it with government spending. Okay, so that's the biggest part of theirs. Similar to if we were going to stimulate in the US, we would stimulate the consumer because it makes up 68% of our GDP. So the fastest way to get there is to go after that biggest slice. So that's exactly what they're doing. In order for China to be the engine for the rest of the globe, I think what needs to happen is that the consumer needs to come through. The Chinese consumer needs to come through in the same way that we expected it to come through post-COVID, and they did not. And the reason that they didn't is because of everything that was going on in China. Property prices falling, sentiment plummeting. Dan, as you mentioned, GDP growth getting closer and closer to where the US is, which is very low for an emerging economy. So we would need the consumer to come back. I think some of these measures are helping from a sentiment perspective, but really the only thing that has been targeted at their consumer is allowing people to refinance at lower mortgage rates by roughly 50 basis points. I don't know that that's going to do it. I think there's probably going to need to be more in order to get the Chinese consumer to spend and actually reignite growth, particularly in consumer names around the globe.
Yeah, I'll say this as well. I agree with Liz. To me, this is, although they can talk about how it's targeting the economy all they want, and obviously there's some aspect of that, to me, I think what they're really targeting are their markets and the statement or the message their weaker markets have been sending to the rest of the world as well. I think they're laser focused on that, and we'll see how long that lasts. So I think that's something to watch. I just want to take you, a few thousand miles away from there, Dan, and let's take a look at something that's happening in Japan. You go back to January of 1990 and look what happened to the Nikkei, and then subsequently look what happened in early July. We traded up to those prior levels that we had seen 34 or so years ago. That, by the way, coincided with the weakest level in the yen we had seen in some time. And then a lot of things have changed since. And, FXI is the lead and China is the lead. But meanwhile, the Nikkei was down almost 5%. I mean, think about that for a second. Think about if we were to move 2% here in the United States and the headlines that creates, and the fact that we didn't do it for over a year and a half or so in terms of trading days. And this is nearly a 5% move to the downside. So I think that's absolutely worth watching in terms of what's going on there. I'll say this again quickly because I do think it's important. I mean, the Nikkei had that all-time, we traded up to those prior all-time highs, and look what's been going on since. You obviously had a huge move lower into August 5th. That's something that basically went from 42,000 in early July down to 31,000-ish on August 5th. You had the subsequent bounce, which got us basically halfway back of that move, and now this 5% move. So just keep an eye on Nikkei. I understand that people want to talk about China. I get it. But what's going on in Japan, I think, is equally important, Dan.
Yeah, no doubt. I mean, when you think about China is obviously the second largest economy, and I know Japan is right up there. And from a market perspective, I think your levels on the charts are pretty fascinating. 1990 at almost 40,000. It bottomed out in 2009, I think as low as 7,000. Okay, so you can do the math there. That's nearly 20 years, right, to go from 40,000 down to 70. And then since then, over the last 14 years, we just made a new high there. I know that this was a really hot trade. And this is what I think is important, guys. This is what I think you're getting at, too, is like this was a hot trade earlier in the year where investors were looking to kind of go further afield than the U.S., right? And so you had the Japan thing. You had a lot of focus on this currency, the unwind of the carry trade. And now it seems like a baton has been passed to investors really focused on China, which tells me a little bit. And we talked about David Tepper last week a little bit where he went on CNBC. He's the former, Appaloosa manager of that hedge fund, legendary investor. Now he's the owner of the Carolina Panthers. He said he was buying everything basically in China that wasn't bolted down, which I thought was really interesting. But I want to bring it back to the S&P 500 here because I think we're like 36 days away from the election. So Liz, here we are. The S&P's up 20% on the year. It seems like all things go. We had that rate cut, first one in 4 years, right? People feel pretty good about a soft landing. I know there's plenty of stuff under the hood, but how are you thinking about October into this election? Because this has to be, other than I think you go back to 2000 or 2008, one of the weirdest election cycles given what's going on, broadly in the U.S. economy, but also globally.
Yeah, there are a lot of cross currents in this election cycle, and it almost recently feels like the election has actually taken a back seat to a lot of the other headlines. So the normal pattern at this point in the year is that you see volatility in September that lasts through mid to maybe late-ish October. Now that's seasonal every year, but typically the seasonal volatility ends earlier in October if it's not an election year. So what you would expect from an election year is that we see volatility drag on a little bit longer into October. There's also a school of thought where markets don't like change, markets don't like uncertainty. We know that. So can the market action in the next 30 days or so predict who the winner of the election might be? In the sense that if the incumbent party is going to stay in, the belief is that the market would be positive. If it's going to be a change of power, the belief is that the market would be negative. So it's one of those difficult times where I don't know what comes first. Is the market going to tell us, or are we going to tell the market what to do when things happen? But I would be vigilant since September was not as volatile as usual. I would be vigilant in October and watch for some of those big shifts. And then, as we know, some of the most sensitive sectors, you've got things like aerospace and defense that usually gets hit, or at least sees volatility based on policies and how polling is going. Healthcare can be up there, although I do like healthcare right now in this environment. So just being careful and being vigilant. But as always, I would never position a portfolio ahead of an election based on what you think the outcome is going to be.
I have a question for Elizabeth Dan, if I may, and she is extraordinarily well equipped to answer this, I believe. But the TLT, which is obviously 20-year treasuries, but I sort of sometimes conflate 10 and 20 years because I'm not that bright. But with that
Long is
said,
long.
I
Yeah.
don't long is well for some things, but in terms of the TLT, you had this sort of move higher in the TLT, yields moving lower into the middle of September when the Fed obviously announced that 50 basis point cut, which I think was expected by half or so of the market. Since then, the TLT, which probably topped out a little north of 1 and 1.5, has traded down almost every day. Now, with that said, it's not like it's trading down in big numbers, but it's trading down sort of in a stair-step type of fashion, which means yields have actually started going higher on the back of these rate hikes. Rate cuts. The market doesn't seem to care, Elizabeth. Should it, is my question.
Well, so yields have moved higher in the 10-year as well. So I think it's okay to conflate some of that. I think what happened into the Fed meeting is that people, whether it was published or not, believed that if they only did 25, the chances of them being behind were higher. So there was a concern about a recession if they were going to be behind the curve, in which case you get spooked, you buy longer dated bonds. And then this 50 basis point cut seemingly has taken both the markets and the Fed to a position of saying, we did it. We have emerged victorious, and we no longer need the protection of these longer dated bonds. So there's been a sell off. Plus, people needed to free up some cash in order to buy other things and chase the rally that was going to happen on the other side of the 50 basis point cut. So I think part of this is just, again, the market baking in the soft landing narrative. Now, should people pay attention to it in the sense of, and I said this earlier today on CNBC, when everybody is so certain of a particular outcome, you have to question the outcome and you have to still make sure that you have a position or two in the portfolio that would benefit if that outcome does not come to fruition. And one of those positions would be long-term treasuries. So if a soft landing does not come to fruition, where do you want to be? In the moment that the market realizes a soft landing is not coming to fruition, you want to be in longer dated treasuries.
Yeah, interesting. If you just want to talk about Fed funds guy, I know you're talking about the long end here. It brings me back to I keep hearing a bunch of comparisons to what's going on right now to like the mid 90s to the late 90s. I don't know if you guys have heard some of this stuff as it relates to the S&P 500. Maybe it's about the rate cutting cycle that's starting at a time where, GDP where it is, where unemployment is where it is, a whole host of things. And again, we can pick apart a lot of that data. But I go back and I look at Fed funds from 1995 until, they started cutting rates in early 2001, the Fed funds was between basically 5 and 6%, right? And, it was raging. So look at these returns for the S&P 500. The average return from 95 through 99 was about 29%, 37.5 in 95. And we know that Fed Chair Greenspan just called irrational exuberance, right? That was his call right there. 1996, 23%, 97, 33%, 98, 28.5%, and then 99, 21%. And you know what's crazy? Even in 2000, when people think back to the dot-com implosion, in 2000, the S&P was only down 9%, right? And again, this was a really weird thing that happened for all intents and purposes, but it wasn't as weird as 07, 08, 09, right? And so again, if we just started this rate cutting cycle, I think it's important to remember that the S&P from its highs in 2000 to its lows in late 02, again, was down like 50% or so. We don't have anything. Maybe it's geopolitics. Who knows what the thing will be? And Guy, you made this point on a couple of occasions, but Liz, when you see those sorts of returns and you see, market participants and strategists right now talking about that period, talking about a soft landing, which again, I think you just hinted at, a lot of folks want to say mission accomplished. Do you see any comparisons to right now in that mid to late 90s period?
Sure. So the comparisons would be, first of all, we obviously don't know how deep this cutting cycle is going to be. Every cutting cycle, I believe, maybe not everyone, but many cutting cycles begin with the hopes of a soft landing, the hopes of actually accomplishing this task. So the similarities, I think, right now would be that the market is optimistic, but not terribly overextended. We didn't get into entirely overextended territory until we got closer to 2000. So we're at that point where we're getting a little frothy. We were particularly frothy in tech, but not completely egregious. So the optimism is there to continue to drive it upward. Where there are differences, and this is the one that really bothers me about that period, is that they started cutting rates into a strengthening economy. We had unemployment at 5.6% and falling. Right now, we have unemployment at 4.2% and seemingly rising. So, this is a different environment for them to be cutting rates. The other thing that I would urge people to keep in mind is the couple of times that we've pulled off a soft landing in a rate cutting cycle, so mid 80s and mid 90s, those rate cutting cycles were pretty shallow. They did not cut all the way down to 2%. They didn't cut down to 1%. So, depending on where we think neutral is here, the amount of movement in the Fed funds rate matters. So, if right now we believe that we needed to get from 5.5% down to the Fed's neutral, which is 2.8%, that's a big move. And the faster they get there, the less it's going to look like that same cutting cycle as the 90s.
By the way, Gina Raimondo was on Squawk Box this morning, and she called it a feather top landing. She acknowledged that debt levels were too high, but she basically came out and said some wonderful things about the economy and how things are going. I think it's somewhat political. We'll see. But, I read the Barron's still, Dan. I think you are familiar with that publication. And quickly, they pointed out that the gold market, which people have started to talk about, we've been talking about it for quite some time, is what it is, but they labeled it a bit of a warning sign. And I would agree with that. I mean, historically, when you see moves like this in gold, and this is a move we haven't seen in quite some time, but just sort of the duration and the magnitude, it suggests, I think, below the surface, there's some things going on. So that's important to watch. There are earnings this week, Dan. To me, the one that sort of sticks out is Nike tomorrow for a myriad of different reasons. Obviously, Nike and Starbucks are sort of attached at the hip in terms of some of the issues they have, in terms of some of the areas of concern that they've been experiencing, and obviously in terms of the bounce we've seen in the stocks over the last month and a half. Nike to you, Dan, important, or I think, by the way, that you fade this move we've recently seen to the upside. I still think the Nike problems are far-reaching and take a lot longer than a couple quarters to figure out. We have bounced, I think, from about $70 on the downside, almost up to $90. That's a pretty significant move, but we theoretically are at sort of the resistance level that we traded down from precipitously in mid-June. Thoughts on Nike?
Yeah, and to your point, I mean, it's filled in that huge gap. I think we were all aghast at that gap back in June, and did they kitchen sink that? Was the guidance, bad enough? You're seeing a Chinese consumer maybe coming back. And again, it's probably too soon to make that assessment, and that's one of the things where it's really important, as you guys do all the time, is kind of breaking down the difference between what is going on in the economy and what's going on in the market. And some folks like to chase in these sorts of environments. But if, Nike was trading very near those lows, you'd say, all right, maybe the risk reward is okay given where they reset guidance to. But if I look at the response to the last three quarterly reports, it was down 20% in late June. It was down 7% as prior quarter in March, and it was down 12% in the prior quarter in December. Think about the magnitude of those moves and the company's inability to basically forecast their own business, or maybe they're just, and you made this point, Guy, in Fast Money Bunch, they are mis-executing. They're getting outdone, I guess, by like the Vioris and the Alos and the OnClouds, and I mean the list goes on and on. So that maybe there's some very specific things here. I don't like the setup into earnings, when you have that sort of move. And lastly, I'll just say this. We are trading right now at 88.88. That's kind of a weird price to be trading. I'm just saying, I just saw that on my FactSet screen. But Liz, when you think about consumer discretionary, we knew Lulu had a really tough quarter. There's some other names like this. Do you see risk as a I guess if you want to look across consumer discretionary, or in your minds, and I know you're not going to opine on individual names, are some of these stocks just mis-executing, or these companies mis-executing?
Well, I think some of them are. Of course, there are going to be idiosyncratic risks, especially in the consumer discretionary space, because fads and tastes change so quickly. It's tough to keep up with. But when you bring it all together and think about what we've heard from Walmart, what we've heard from Costco, what we've heard from other discretionary names, it's clear that consumers have changed their behavior. They haven't stopped spending, but they've changed their behavior. They've become more price conscious. They're upping the volume of things that they buy when prices have been dropped. So some of these brands that are really trading at a pretty high price point have probably been sacrificed for things that they're trying to find at cheaper levels. The other thing I would say is we're finishing the third quarter today, which means that third quarter earnings season is about to begin. And when you look at just the sector lineup, the expectations of which sectors are going to generate earnings growth, consumer discretionary is at the bottom of the pack. We've got negative 0.1% expected growth for the third quarter. The only sectors below are materials and energy. So, and even consumer staples not expected to generate much. So, this is not a quarter where I think investors are going to be looking to consumer companies to drive the engine for the stock market.
Real quick, Dan, before we 5,000 semis, interesting. NVIDIA, obviously that huge engulfing pattern we've talked about on June 20th when it made an all-time high of $140.76. Like everything else, had a huge sell-off into August 5th. I think we got down to $90 or so. Subsequent bounce, but here at 120, the stock has sort of been treading water, I guess, for the last couple months. Thoughts on semis here?
Yeah, so I think there's two things that I think are really important to the markets this week is semis and how they act, and then obviously the all-important jobs report, which we're going to hit really quickly before we get out of here. But when I think about this, and Guy, you and I were both looking at that Micron report last week as it was coming out and the guidance that the company gave and the beat on the report. And you and I were like, wait, why is this stock up 8%? And then it was up 10% in the aftermarket. And then it opened up 15%. And I think you and I, well, it was up 15% in the aftermarket. And you and I were both of the mindset on Fast Money. I would not chase this given what they said. And I think a lot of it was just kind of how downtrodden the stock was, kind of round tripping that whole move from the spring. And then I look around and I see NVIDIA. So NVIDIA is down a little bit today, but, Beijing, I mean, the government there is telling their local, manufacturers of electronics and servers and the like to buy locally there. You would think that NVIDIA, and they name specifically NVIDIA, so you would think that NVIDIA would be down a bit more. The fact that Taiwan Semi is down 2% on that is kind of interesting to me. So I just feel very strongly, keep an eye on these semis. I just think that, there's, as they go, I think the NASDAQ goes, and ultimately the S&P. Are you in that same camp, Guy Adami?
Yeah, I do believe that. I've been watching them very closely. I think Micron traded up about 114 or so in the day after earnings, and people were very excited. As we're sitting here today, it's probably either side of 104. So it's been slowly giving it back. I thought that news out of China also was interesting. We've talked about super micro a number of times. I don't think the market's paying enough attention to maybe some of the tangential effects that story will have at some point. So yeah, you always have to watch semis. But again, Liz, as Dan just sort of alluded to, you almost have to say it, the all-important jobs number on Friday. You'll probably be part of an 8 box on one of the shows.
No.
Thank God. You shouldn't
No
be,
more,
by the
no
way.
more 8
Nobody
boxes
puts
of
Elizabeth
Europe.
in the corner. Thoughts on, I mean, are we past, well, I don't think it's interesting. I think we're past the inflation part of the concerns. You brought that up a number of times, and I think now we've sort of transitioned over to the concerns around the labor market. So I do actually think Friday's a big day.
Yeah, we've definitely shifted gears. And I wrote a column a few weeks ago called Demoted, and it was about the inflation numbers getting demoted. People don't care as much about them because we've decided that we defeated inflation, which we didn't entirely, we know. But the labor market does hold the key. I think it holds the key for the rest of the year. The expectations are for an unemployment rate that stays steady at 4.2%. And we recall that last month it went back down to 4.2% from 4.3%. That 4.3% reading was what sent us into a tailspin back in August. So watching this very, very closely, any surprise to the upside in unemployment rate is going to be a disappointment for markets and a threat to that soft landing narrative. We've talked about this a number of times. I continue to be concerned that once the unemployment rate starts moving up, it tends to move up very quickly. We're just at that inflection point right now. So watching it closely, the pushback will be that there's no evidence in jobless claims that anything is wrong. And jobless claims are much more of a coincident indicator, meaning we get updates more often, and they would show signs of stress perhaps before some of these monthly numbers would. And we're not seeing anything in those jobless claims numbers yet that indicate major stress. But who knows what's going to happen on Friday? We got surprised in August. We could get surprised again. And I'll tell you what, if this unemployment number comes in surprisingly high, or if non-farm payrolls come in surprisingly low, it does run the risk of sending the market into a very volatile place once again.
Speaking of coincidences, today is the birthday of one woman that we love dearly collectively. That, of course, is Amanda Diaz, the glue of risk reversal media. And another young lady that we also love dearly, that, of course, is Ellie Nathan, who's turning 19 today, enjoying her early freshman year at Georgetown University. So a very happy birthday to both of them. Stick around, by the way, Elizabeth, and always great having you. We had a great conversation with Vincent Daniel with Danny Moses that you should listen to. So we'll see you on the other side. We're sitting around, we're just yucking it up. And who walks into the studios?
Vincent Daniel.
Vincent Daniel. Typically attached at the hip with Porter Collins.
Parts unknown right now. Porter
Parts
Collins.
unknown.
You're not
Porter
doxing.
Collins.
Weight
I won't let you.
unknown.
Weight unknown.
It's a professional wrestling thing.
Really?
If you ever watch
No, I
wrestling.
know.
Yeah.
Well, parts unknown, weight unknown, but you're with us now, which is fantastic because over the last couple days, your world is sort of opening up. Like all the things that you've been talking about have been working in an epic way. Some of it predicated on this bazooka being used by the Chinese. Thoughts?
A lot of thoughts. First off, thanks for having me here.
Come
This
on.
is awesome. I'm going to the Italian Gun Club tonight, Tiro. Have you ever been there? Any of you guys have
I
ever
was there
been
last
I think
Thursday.
Dan Nathan was just
It's amazing.
Amazing.
You have a sport jacket?
I do have a sport
You need a
jacket.
jacket.
Oh, he
buddy-
walked in with it. You should see it. He's looking good.
My buddy Bobby Comp invited me.
So let's just
Bobby Compitello.
hold on. Let's just break this down a little bit because you go in there and it seems you should be there. Like this
Yeah.
is a Guy Adami sort of place.
1000%.
They bring you into the lounge. You have a cocktail. They bring you out a plate of meats and this and that. You sit there. Then they bring you into the dining room. They serve you a first course. And then what do you do, Vinny?
And then after the first course, you take a sojourn downstairs to the basement where you shoot a gun
I like
at
that.
targets.
You would love it.
at Targets.
Yeah.
Yes.
And then
A target.
And then everyone from your table, you're kind of competing because they'll give you a score on your target.
Well, it's like when Michael went to the basement with Clemenza.
Yeah.
And Clemenza was showing him how to,
Use the
shoot
gun,
the
yeah.
gun.
Not on my ears.
Remember? Yeah.
Why-
I left it loud. Scare away any
Why do you think?
bullshit
Why
innocent
did he say
bystander.
drop the gun? And I know there was no prints on it because he
You
put
don't
the
have the
tape
gun
on it.
on you.
Why not?
Why not?
Or implicate.
What if there are guys in the car that were with the chief and the?
No.
You gotta-
No. There was. Forget about the car. He got the gun in the bathroom.
Yeah.
At Louis' place.
Yeah, behind the toilet.
By the way, what's interesting about that scene, and I'm sorry, Vinny.
Just
I-
really
no,
quickly,
go.
just
Roll.
for the non-Italians at the table here, this is Godfather 1 we're talking about
Yeah.
right here. Yeah.
The Godfather.
The Godfather.
They don't say Godfather.
Well, because
it's
it came
the
out. It was just the Godfather. But they knew they were
But
going to
you know
do
what's
two.
interesting?
Yeah.
Francis Ford Coppola told the prop guy was supposed to put the gun on one of the stalls, he didn't do it. He put it on the other. So when Michael is fumbling around, that's really Pacino. Like, where is this damn thing?
Yeah.
Genius.
Authentic. All right, should we get to the
let's
markets
go.
and all this stuff?
Yeah. So Vinny, please.
So, it's funny. I don't do this that often. I apologize. So in the morning, Porter's been away. He's in Italy.
Up, doxed.
Sorry. Yeah, that was douchey of me. I'm sorry. And I'm watching CNBC, and they have one of the goats, Tepper, on, right? And I was sitting there laughing my ass off because 5 days ago, if you would have had someone come to this podcast and pitch China or any other place at a macro dinner, at a macro lunch, every single institutional person, professional, would tell you to be short China. Every single one. Either short China, don't touch China, China's bad, don't ever go near it. As a result, don't own the metals, don't own iron ore, don't own anything. And here comes Tepper the goat, who's been saying, I've been buying the crap ton out of it. Great interview. And when I think Becky asked, she goes, what do you own? And he says,
Everything.
everything.
Makes a quarterback change. In Carolina, they win and starts buying China ahead of the stimulus.
We could talk about the NFL
Vinny,
in
as
a
someone
second,
who,
but-
I know you're not a daily watcher of CNBC and the like, and David,
I do
David Tepper,
dabble.
formerly Appaloosa, and now he manages his own family office. He bought Charlotte
Panthers.
He bought the Charlotte Panthers,
Charlotte Panthers.
Carolina Panthers. He's not a particularly well-liked man down there, by the way, since he bought the team.
I think his issue down there is when you draft a 6-foot quarterback, which is a low probability event, unlike in markets, you don't have the Fed to bail you out of your mistakes.
Look at it. I like what you did there. I was just going to say this really quickly. So he has had some of the most legendary calls on CNBC coming on and calling. Is it that useful? And I'm not coming at him. The guy's, he's like you said, he's a goat. Like, we're 5 days into this rally, and he comes on and says, I'm buying everything. I mean, I think there's risk to that you draw in a lot of retail.
Well, he's not lying because you'll know when he sees
I don't
his
care.
returns.
I mean, but what I'm saying is like he's called bottoms before, and he's actually calling the bottom at the time. I just don't think it's particularly useful after the fact.
Here's what we saw, and again, sadly, I don't have the size that he has on.
That's what she said.
We own a little bit of JD.com. I own Baba, but what we saw that I probably unlike him is that these things were so damn cheap.
Yeah.
So on their ass.
Didn't take a lot.
Their balance sheets were pure, assuming you trust what you're looking at, right? Which is a big deal. I think at one point, 40% of the market cap of JD was in cash, right? So it was a margin of safety. Why not? And heaven forbid, China decides to stimulate, which they did. Now, I think the more interesting question, and it actually dovetails to something more, is can we name a large sovereign central bank right now that is not stimulating, right? We have more stimulus and loosening of financial conditions now than we've had in years. And as a result, the question we keep asking ourselves, and on top of that, you have rates which refuse to acknowledge the loosening of financial conditions, and energy which refuses to acknowledge the loosening of financial conditions, which is extremely beneficial, all else being equal, on the incremental margin to the consumer, right? It has to be. So what we've been doing is doing a lot of, we covered a lot of our shorts that were rate sensitive, and maybe some of these cyclicals will have a bounce. Right? A decent bounce, assuming this continues. And I don't see for any reason why it won't continue.
Well, Vinny, in China, they're calling it, I've heard people say it's a relief package, not a stimulus package. But you're right, they did finally do some type of fiscal stimulus. But the last time you were on CNBC on Fast Money a couple months ago, I think it's been a couple months now, you specifically pitched uranium at the time. And it was actually on its ass. And so another joke you made here before walking in here, you're also watching CNBC, and all of a sudden, all you see is uranium. Now, give Tim credit. I mean, he's been on this.
He's a handsome man. He's a handsome man.
For a long
Very
time.
handsome man.
But
lead singer.
Yeah, but there actually have been secular changes. It's not just about AI is actually, who would have thought when AI was announced and it came on the scene 2 years ago and everybody got excited about it, that it would result in uranium benefiting from it, which is kind of really interesting. So talk to us on an update on the uranium trade here, and what are your thoughts?
Well, you are right. I guess I've been an avid watcher of CNBC. I go to the gym and I see you guys on. Right, you're on the screen, and I'm laughing because I see you guys, and then I see uranium, and it's like 3 days in a row. Like, oh, holy shit, this is all.
You still didn't sell though.
What?
You still didn't sell it.
No,
on that.
we had it. Look, when Microsoft and Amazon announce major initiatives for their AI to get their energy from a source, nuclear, both of them, right, within a month or 2 month time frame, that means the incremental demand for uranium going forward is going to be up, and the supply of uranium, just because it's really difficult to open up a mine, it takes a long time to do it, is limited. It's my favorite fundamental investment we have at Seawolf right now. It has been for a while. It hasn't worked this year up until, I would say, the last 2 weeks. And that's the reason why we were adding in the summer. Slowly but surely, and we started to accelerate our ads once we saw the Microsoft news.
And a shout out to your boy Cy Jacobs, who I think you just had lunch with, who we're all friendly with here, who has mentioned to buy Sprott, which has the 2 closed-end funds on gold that we talk about, PHYS and SRUUF. And so you just had lunch with him. I assume he's still as positive on this stuff as he was before.
Very positive.
Right. I don't want to speak for size.
We talked Mets, Jets, and uranium, and a little bit of banks.
Well, those are all things that have been doing well. So let's talk about like everybody's All-American in uranium is, depending on how you pronounce it, either Cameco or Cameco. I'm a Cameco guy, but the symbol is CCJ.
It's Canadian listed, yes.
Which since June has been awful. But that, to me, is one of those plays that makes sense. Danny just mentioned SRUUF, Sprott Physical Uranium. There are a lot of things. I mean, this is a secular change, and you throw in the fact that if Russia ever says, you know what, we're not going to export uranium anymore, all these other metals, there's a tremendous tailwind for the entire space.
Yes. And to add on, the way I think large institutional capital has been playing this has been through the utility companies. So look at Constellation Energy and Talon Energy. I believe the miners, other than CCJ, which had a massive run in 2023, a lot of the miners, left for dead is too strong a term, but they've lagged. I think they'll have their comeuppance. And as Sai has mentioned, the asset manager, Sprott, the asset, I like calling it Sprott.
SII is the symbol.
SII, the other major asset under management under Sprott, not just uranium, is silver and gold, right? So you talk about, Seawolf Nirvana, to be an asset manager of all things commodities, mostly silver, gold, and uranium is a great.
And I tell
great
people
thing.
the way that Sprott structures these closed-end funds, they actually own the physical, unlike GLD, which, yes, supposedly can get somewhere to a vault in London and get you that gold. But Vinny, one other name actually that Dan and I were talking about this morning, BTU, Peabody, or this guy would say Peabody, Peabody, whatever, all of a sudden is up off its ass. And I couldn't find the reason until you walked in here, which is really interesting when you think about this thing. Maybe just a bridge too far a little bit here where we are, but explain to people out there, again, it's a coal company. Explain why it's gone up by an activist getting involved and the reason they're getting involved.
So let me explain. This sounds like a low probability event, and it might be, but it's a sneaky AI play. Like how in the world is it? How is coal an AI play? Well, about a month ago, an activist has taken a fairly large stake in the company. And one of the initiatives they would like to do is to take Peabody's Wyoming-based thermal coal that they extract out of the ground, the Powder River Basin, think Yellowstone, the show, right? And right now, when you take that coal out of the ground, you put it on rail cars that are owned by Uncle Warren Buffett, right? And goes to various utilities for whoever's still using coal. The spread on that is extremely low. It's like $1.50 to $2 per ton of coal. The reason being is Uncle Warren, who has a monopoly in rail cars, extracts most of the economics. This activist, we believe, would like to say, hey, rather than do that, rather than give the coal to Uncle Warren and put it on the rails, why don't we try to attract a data center in Wyoming
To build something
here, fueled by coal. Now, they're going to need a little bit of an ESG narrative going.
Field of
maybe it's
dreams.
carbon sequestration, right? But perhaps you can turn $2 per ton into $6 per ton. And I think that's the reason. I think one of the reasons Peabody has been going up, Natty has been going up, because people are starting to get the joke that AI is an energy-sucking growth initiative. And we have to fill that energy somehow, some way.
That was symbol BTU for those people out there. They're playing home game.
Yeah, that's right. It comes out BTU, as you would say, Guy. Really quickly, and first of all, I think there's going to be a shit ton of pushback or pushback
1,000%.
on the energy thing, because again, if you can't get the use cases, if they're not coming, if there's not enterprise demand for this store, the amount of energy they're taking to kind of do this crap, I mean, I think there's going to be overcapacity built on every which way over the next year or so. And
2 years, I agree.
Yeah. All right. Really quickly, because you mentioned that you guys covered a lot of your shorts that are rate sensitive. We've been talking about Tesla for years now, but Guy and I were talking about this, I think, a couple weeks ago into the Fed rate cut. It's kind of hard to be short this anymore. Elon's been talking about how rates have been a huge drag. They've been spending a lot to buy down rates, right, just to kind of get people in these cars or so. How are you guys thinking about that? Because, again, there might be some robotaxi excitement that's built into this move that we've seen. But at the end of the day, this rate cut, and if there's going to be a cycle, should be really good for Tesla.
Correct.
Yeah.
Sadly, I don't have a response otherwise. It'll probably increase the amount of cars that they're going to sell. He should actually, it doesn't really matter to the stock. It's now an AI robotics initiative. So the auto business doesn't matter anymore. And I'm sort of tongue-in-cheek, sadly, angrily joking about that, but that's the way the stock acts. He also, as you guys are probably painfully aware, he has been the biggest advocate for a Trump candidacy out of anybody. And so as a result, it's a bit of a partisan stock, although in typical Tesla fashion, even if Kamala looks like she's winning, the stock still doesn't go down. So I always say this is an analyst's worst nightmare, this stock, because no matter what numbers you put in, and I could say that, well, with lower rates, he's teasing them more, lower margins, it doesn't matter.
Well, to your point, I would just say that from a valuation perspective, an extra 10 or 20,000 deliveries is not, to your point, what's moving the needle right now. He's got control of the narrative back. I think this China stimulus somehow people think it's going to also help the company, which maybe it will in some regard. But we've always found that when shorts break out of not trading on fundamentals, they're dangerous because you don't know what the driver is going to be or what's going to knock it back to bring it back to reality. And in October, he's going to come out with something. It'll be like when he did the boring tunnel and drove a car through it, and everyone said, "Oh my God, you drove a car through a tunnel." I mean, so you're gonna have a Price is Right moment where there's a car driving across the Showcase Showdown, coming across by itself. So, whatever it's gonna be. So, but
yeah, one thing I just want to say, Vinny, and I kind of been thinking about this a lot lately. Let's just say, no matter who wins, obviously, if his candidate wins, it's going to be good for him. Okay. I think if Kamala wins, I think it's actually going to be good for him. I think she's going to have to bring these folks, a lot of these very innovative like entrepreneurs from the West Coast who've kind of been, taken another side, obviously. I think she's going to have to bring them into the fold. I think there's going to be a movement towards the middle one way or another. And I think that I don't know how you could just disregard someone as important as he is as it relates to SpaceX and Starlink and all this stuff. Danny's growling a little bit. You disagree with that?
Sadly, think that's a higher probability event, what you just said, than I would like to believe. Yeah. If you're attacking me every day, and this is where politicians are different than normal folk, every day calling me an idiot, right? Judging our leadership, everything, and all of a sudden I win and I strike a deal with you, I can never be a politician because I would never allow that. I would not do that. But you are probably right.
Well, she's not attacking him. I mean,
he's attacking her.
Okay, I'm not on the Twitter, so I'm not seeing what's going on.
Eviscerates.
Every day?
Constantly.
Okay.
Constantly. And you're probably right. She will probably acquiesce, just like Trump acquiesced to Musk, to crypto. This is what
I think no matter what happens, in November, I think all of us, we're just exhausted. We just want to see things.
We got another month, guys.
No, I know, but we want to see things tack back towards the middle. We want to see things get done on both sides, right? There's just so much, of this kind of bipartisan fighting.
Vinny, one of the other things that we have been talking about is consumer credit in general. And I think more importantly, behind the scenes, what's really driving the markets are easing credit conditions, which, by the way, we're already easing before the Fed cut 50 basis points. And it's been a big driver in this search for yield by investors. They'll buy anything, right? So you're kind of seeing conflicting trends to a degree, a little bit of deterioration in credit quality and auto, et cetera, yet the demand for the paper itself is creating basically, obfuscating any concern. So I know CarMax is a good example today that was down a lot. Now it's up. Maybe talk about this, pick one, used car market or auto loans.
Well, let's just start in general. I think if this economy, if there's any upside to economic growth next year, right, it's going to come from housing, in my opinion. And I'm going to dovetail into credit in a second. With rates coming down, I think housing, which I'm going to make a controversial statement but explain it, which has been in a recession slash bear market for the past 2 years. And when I make that statement, people will instantly retort at me, but look at the builders, right? The builders have not been in. Separate what the stocks have done and the performance of the builders from the housing market. The housing market, if you look at Home Depot, if you look at Builders First Source, the revenue growth there has been negative, right? So if rates stay down, I think you will see more housing activity than people expect. Not only that, Danny, here comes the second part. You will also see, on the margin, slightly more mortgage refinance activity. And with mortgage refinance activity comes better consumer credit of the higher yielding credits, whether it's auto, whether it's credit cards. So what I think we're seeing right now, assuming rates stay low, and I'm very much rates are a leading indicator type of person. If rates stay low, then I think what you're seeing from CarMax, from Ally, from some of the other things are a bit lagging. But we'll see. If you tell me, no, Vinny, I think rates are going back to 5.5 next year, then I'm going to change my tune in terms of where I think consumer credit's going to go.
Before we get out of here, we have to talk about gold, which has gone up with the dollar going up, dollar going down, rates going up, rates going down, gold's up regardless. Thoughts?
Our theory on gold, to a lesser extent silver, but I think you could throw silver into the mix as well. It's a bit of more of an industrial metal, is that it's a play on debasement. That's all it really is to us, is a play on monetary debasement and fiscal largesse and fiscal stupidity. We don't see that ending. And what I think the gold market sniffed out
100%.
everything that we're beginning to see tangible evidence of what we thought was going to be a few months ago. Has it moved a lot? You bet your ass, right? Can it pause here? Yes. But until we really change our tune in terms of monetary and fiscal stimulus, and now we just got China, and I believe today, I missed it, but Europe was actually pushing that they're going to be lowering rates as well. It's kind of game on.
Look, I mean, I think you could actually start connecting dots and say maybe one of the reasons China's been buying gold hand over fist for the last couple of years is it was anticipation of what they just said over the last couple of days. So in some ways, that's the hedge of all time against what they just basically enacted over the last 2-3 or so days. It is a joy having you join us. I don't know where Porter is. I don't know this Porter, as Dan says. I don't know what he does for a living, but I know you, Vincent, and it's a joy having you sit next to me here on the tape. Thank you for joining.
Thank you. Thanks for having me.
Thanks, Vin.